Hello guys, Steven Ducks here. Welcome to this video. So today we're gonna go over some of the tickers that happened in the last 2 weeks, and also I want to give some of my personal thoughts about how to really stay disciplined and how to really stay consistent, profitable, especially in this really I would say low liquidity year. And what I've noticed from other traders and personally from my own reaction from different I would say pattern behavior. Let me share some experience with you, and other than that, make sure to click the like button and subscribe, and let's get into the video. So today I'm gonna go over 2 tickers. One is PALI, one is EUDA. So PALI, this is one of the tickers that I've noticed. It happens every single year. Whenever you see a market cap that's really low, under I would say 5 million or around 5 million, and flow is really low, if it's considered to be a low float, it has to be below 3 million. 1 to 2 million, it's approaching to nano float. Whenever you see a low market cap and a nano float, typically the ticker tends to spike a lot more compared to the market cap is a lot bigger. As I mentioned in the previous video, that if the market cap is around 1 billion, then it takes another 1 billion to be injected into the market cap for this ticker to go up 100%. So as long as the market cap is really low, it needs much less equity to pop the stock up. So whenever you are looking at a 5 million market cap, that means you are almost at the lowest market cap in the NASDAQ. And whenever the stock performs a gap up short and trades tons of volume in the pre-market, you always want to be careful with a massive squeeze that's going to come in the morning. It's because it doesn't really take much for the pumpers or for the people to manipulate the stock for this one to go up 100%, 200% in the morning. Let's take a deep look at PALI. We have tons of volume, red candle right here, shorted against the pre-market high. Now typically whenever you are looking at a gap up short with I would say 20 million market cap with 3 to 5 million float, and the stock pushes about 20 to 30% after market open against the pre-market resistance, that's something that you can be considered to short into the strength. But whenever you are seeing a really low market cap, like 5 million market cap at the very beginning, or even 2 to 3 million market cap, and also you are looking at really low float, always be really careful. I will not short anything that's I would say less than 100% that gapped up in the pre-market. So this is one of the very I would say small details you have to pay attention to. In the future wise, do not touch anything that's I would say market cap is under 5 million and it's up less than 50% in the pre-market, and also it's a nano float. So PALI, this is something you want to stay away from. And once it forms its consolidation, if it's trading, I would say 80 million, 100 million shares during the day, I would not consider to be touching this. I would like to see in the next day, pre-market, I can actually do a volume estimate compared to the yesterday's volume. If the ratio is around 1 to 10, let's say today traded around 100 million, then next day in the pre-market traded around 1 million, so the volume estimate for the entire day should be 10 million. The ratio will be 10 to 1, and that's very good to short into. So for PALI, this type of trend happens again and again. The reason why it went from 2 to almost 6, up 300% in just few candles, is because a lot of people are very, I would say, eager to rush into a ticker that's tradable, and we haven't had any place for a while. So this will make them to sizing much bigger, and they're so I would say they are feeling FOMO that they will likely to miss the spike, and this is what happens all the time on low market cap tickers that trade tons of volume. So that's my thoughts on PALI. Hello guys, Steven here. I will be holding a conference in late February, and I will be giving out the strategies that made me over 8 figures between 2020 to 2022, and also some updates about the strategies that I created back in 2018 to 2019. Of course, the market condition has changed, and also I will be giving out a discount for Trader's Edge, which is the upcoming new course. There's only going to be discount for this conference specifically. And if you're interested, make sure to join the conference, and it's going to be a very interesting time to learn about the strategies that's going to play out in the slow market, and also we are going to review when the market comes back, just like 2021. This is EUDA. Overall, it traded about 10 million shares in the entire day. It traded on Friday, so the market only opened about 4 hours. The trend on this one, let's take a look at the entire history of the chart. Nothing happened until Friday, traded around 10 million shares. So this is a fresh chart. Whenever you see a consistent downtrending candle like this, you always want to be careful with crazy candle actions. Typically, one candle can pop almost $1 if the ticker has been staying consistent downtrending for a month or a year. The longer the time period, the more aggressive the spike will be. So for EUDA, this is something that you will see whenever the chart performs consistent downtrending, then you will see a really aggressive spike in the morning. So the way to trade this, I would say whenever you see a ticker fades about 50% after the massive spike, you can short into the bounces, risk the 75% of the top. Normally also you can potentially risk on the top will be $5. Typically, these type of tickers do not perform double top. My risk management when I'm trading this ticker, I will probably short into the 50% area around 4.5, risking the $4.8 area. So I will size down half and cut in full around $5. And this should be a really small trade. I would say if the volume is around 10 million, that you shouldn't be sizing in over 50K shares. So, on average, maximum should be 30K shares. If you're sizing over 50K shares on one bounce, it's not really worth it. And the risk potential is a lot bigger compared to the, I would say, downside. So those are the two tickers that happened in the last 2 weeks. Hopefully, you guys learned about the price actions and how the market is really giving out plays to all those retail traders. And as I said, the lower the liquidity, and that makes traders, I would say, a lot more eager to jump into different plays, and it makes them to make mistakes. So always be patient and pay attention to the details. That'll be it for this video. Thank you very much for watching. I'll see you guys in the next one.